Which refining stock is the best? Which one is a gem? Which one offers the best dividends? This video has the answers. Hello and welcome to Insight AI Brief Set Tie. Before we dive in, please take a moment to like, share, and subscribe. Now, if you follow the petrochemical space, you know it's pretty brutal right now. You asked us to cut through the extreme volatility of the commodity cycle, this shifting crude prices, regional oversupply, margins just crashing, to figure out which stock, PTTGC or IVL, is really the hidden gem. Where are the best investment insights for 2025?
It really is a tough environment out there, a real fight for survival in this sector, actually. The petrochemical industry in 2024 is facing these persistent headwinds. We're dealing with a slow global economic recovery,
Right.
And that's coupled with massive, just enduring oversupply. It's pushed operating rates worldwide down to really painful levels.
And you mentioned regulations, too.
Yeah, exactly. If you layer on top of that the rising complexity from environmental regulations, like the impending Thailand Climate Change Act, for example, you've got a situation that demands both extreme risk management and some really decisive strategic moves.
Okay, let's try and unpack this. Maybe start with the basics, the financial reality. How do these companies actually make money?
Good place to start.
Because for any commodity business, it all boils down to the spread, right?
That's the core engine, absolutely. The spread is simply the difference between the price of their finished product, could be polyethylene, gasoline, PET plastics, and the cost of the raw material they need to make it, usually naphtha or crude oil.
So if raw material costs shoot up, but product prices are stuck because there's too much supply.
Exactly, that spread collapses. And profitability, well, it can just vanish. It sounds simple, but it's brutally unforgiving in practice.
Okay, let's look at the players. Starting with the integrated giant, PTTGC. You mentioned they're the largest integrated operator in Thailand and APAC.
That's right. And the scale is massive. We're talking nearly 15 million tons per year of petrochemical capacity, plus 280,000 barrels per day of refining capacity.
So how does that integration help them or shield them in this tough market?
Well, their profits are driven by both the refining margin and, crucially, the upstream petrochemical spreads. Things like the ethylene naphtha spread, and also aromatics like paraxylene, benzene.
Okay.
But what's really fascinating right now, as of, say, July 2024, is this outlier. The LDPE naphtha spread is showing impressive strength. It was sitting at US $611 per ton.
Wow, $611. That's nearly double what we see in other standard polyol fission spreads. Why is that specific product, LDPE, doing so well when everything else is weak?
Yeah, it's interesting. It seems tied directly to specialty applications. This particular strength is driven by limited supply of specialty grade LDPE films. Stuff used in high-end electronics like protective layers for new phone screens, maybe specialized medical packaging. These are markets that are just less sensitive to the typical global slowdown.
Got it. But it's not all rosy for them.
No, not entirely. On the other side, PTTGC's aromatics business, benzene and PX, they were weakening slightly recently. Probably due to low summer demand and downstream players being slow to restock. So, it's a bit of a mixed picture for them operationally right now.
A boom in specialty film, but sluggishness elsewhere. Okay, now let's jump downstream to IVL, Indorama Ventures. They're the global specialist, right? Very different model.
Totally different. Built through, something like 50 global M&A deals over 2 decades. They're really focused specifically on polyester and PET.
So their profits depend entirely on
downstream polyester PET spreads. That's their bread and butter. And actually, we saw a dramatic, though maybe short-term move recently. The integrated PE spread surged 43% week on week, hitting US $122 per ton.
43%? Wow, what drove that?
It was fueled by higher PT bottle chip prices and, importantly, lower costs for their inputs. PTA and MEG, that's purified terephthalic acid, and monoethylene glycol, the key building blocks.
Okay, but you mentioned earlier this massive oversupply issue and new capacity coming online.
Ah, yes. That's the big caution flag here. That spread surge sounds great, but it's expected to be pretty short-lived.
Why is that?
Because of exactly what you said. Massive new production capacity entering the market in the second half of 2024. We're talking 1.5 to 1.8 million tons per year.
So if that huge new capacity is coming online, isn't that big spread surge less of a positive sign for IVL and maybe more like a temporary breather before the next big margin crash hits?
That is precisely the right question to ask. You've hit it. The core problem remains oversupply. It feels like in this sector you can be brilliant strategically, But ultimately, profitability can just boil down to, which day you shipped your product before the next supply wave hits.
So the takeaway for understanding the cycle is?
It's pretty clear. Profitability really relies on catching these temporary supplier demand shocks in your specific part of the value chain, whether you're upstream like PTTGC partly is, or downstream like IVL.
Okay, so if we know profitability is this volatile, this dependent on timing and luck almost, then the health of the balance sheet becomes absolutely critical, doesn't it?
Paramount, yes.
So let's pivot from those market spreads and look inside the companies. We need to evaluate their efficiency and financial stability, especially with high interest rates making debt a major factor.
Agreed. We can use return on equity, ROE, as a good indicator here. It shows how efficiently they're using shareholder funds and maybe their potential for a rebound when things turn.
And what are the projections looking like, say, for 2025?
Well, looking at the forecast ROE for 2025, IVL is projected to hit 9.0%. That actually shows the highest projected efficiency gain among the group.
9%, okay. And PTTGC?
PTTGC is projected around 4.0%. And just for comparison, their peer GGC is forecasted about 2.0%.
That potential 9.0% ROE rebound for IVL suggests they might be, cleaning house pretty aggressively.
That's likely part of it, yes.
But debt is the big elephant in the room for IVL, isn't it? Given those decades of global M&A expansion.
It absolutely is. It's the flip side of that growth story. PTTGC, on the other hand, really prioritizes disciplined stability. Their financial strategy is all about maintaining a strong investment-grade credit rating.
Do they have specific targets?
They do, like keeping their debt service coverage ratio, the DSCR, at no less than 1.25. They really position themselves as the conservative anchor in this comparison.
The anchor. And what about IVL's plan? How are they tackling the debt they built up during that expansion phase? They can't just cut operational costs. They need to deal with the liability itself.
Right, and that's where their new strategy called IVL 2.0 comes in. It's designed specifically to address this debt issue head-on.
Okay, what's the plan?
They're aggressively targeting a reduction in net debt by $2.5 billion. The aim is to get down to around $4.3 billion by 2026.
$2.5 billion? That's significant. How are they funding that? Is it just wishful thinking?
Well, they have a plan. It's supposed to be funded by both operational cash flow, about $200.8 billion, and, significantly, $1.7 billion from planned strategic asset divestments and what they call value unlocking.
Asset sales. Okay, that debt reduction plan sounds comprehensive. But given IVL's long history of, let's say, highly leveraged global expansion, how confident are analysts that they can actually execute on that $1.7 billion in divestments? That sounds like the trickiest part.
You've nailed it again. That is the single largest execution risk in their entire strategy. The market is definitely watching, waiting to see if they can bring in that $1.7 billion cash injection without, selling off core assets that they need for future growth.
So what's the key metric to watch there?
The success metric is crucial. They need to push their net debt to EBITDA ratio below 3 times. If they hit that target, it'll signal to the market that the IVL 2.0 cleanup has been successfully executed.
Okay, that makes sense. And that focus on debt and earnings leads us perfectly into valuation. Now, when we look at these big cyclical industrial companies with tons of debt and depreciation, why do investors often prefer EV/EBITDA enterprise value to earnings before interest, tax, depreciation, and amortization instead of the more familiar PE ratio?
Yeah, it's a good question because PE and even price to book, PBV, can be highly misleading here. The E in PE, the earnings, often drops near zero or even goes negative during these cyclical downturns, right? Which makes the PE ratio basically useless.
Right, division by zero or a negative number.
Exactly. EV/EBITDA gives a much fairer comparison because it captures the true cost of buying the entire business, that's the equity, plus all that debt, the enterprise value, and measures it against core operating profitability, the EBITDA. It effectively strips out the cyclical accounting noise from interest, tax, and depreciation that distorts PE.
Got it. So let's look at the numbers. The 2025 forward projections. The data shows IVL is trading at around 4.2 times EV/EBITDA. PTTGC is higher at 5.9 times. What story do those lower metrics tell us about how the market sees IVL's turnaround chances versus PTTGC's stability?
They tell us the market is incredibly skeptical about IVL right now, basically. PTTGC, which is rated outperform by analysts, is valued higher partly because its stability and integration provide this inherent safety premium, you could say.
And IVL.
IVL, rated neutral, has the lowest valuation metrics based on those 2025 projections. It suggests the market is currently undervaluing IVL's potential cyclical rebound. I mean, if IVL successfully executes its aggressive efficiency targets and that big debt reduction plan,
Right.
then there's a strong argument that these low valuation metrics offer the maximum upside leverage once the cycle eventually turns.
Maximum potential reward, but also maximum execution risk, it sounds like.
That's a good way to put it.
Okay, we've analyzed their current battles, their balance sheets, valuation, but let's look further out. Beyond this volatile commodity cycle, these companies have to navigate huge megatrends like accelerating energy transition, global climate policies. What are their big strategic bets for the future? How are they adapting?
Yeah, this is absolutely critical. This is where their long-term viability truly lies, beyond the cycle. And actually, both companies are making a major pivot toward what PTTGC calls high-value, low-carbon business.
High value, low carbon. Okay. What does that look like for PTTGC?
For PTTGC, it involves significant expansion in bio and circular businesses. For instance, NatureWorks, which is a leading bioplastics producer, making PLA, polylactic acid. They're building new capacity, 75,000 tons per year, at the Nakhon Sawan Biocomplex. So a big bet on bioplastics.
And you mentioned circular. They're getting into recycling too, tackling that waste problem.
Exactly. Through their subsidiary ENVFeco and partnerships with major players like Nestle and AIS, they're focusing on securing waste streams to produce post-consumer recycled plastic, or PCRPT.
Makes sense.
But perhaps their most talked about move is in the air, so to speak.
Sustainable aviation fuel. SAF. That's becoming a huge deal globally, almost a regulatory necessity.
It really is. Commercial production of SAF is expected to start in January 2025. They plan to use cooking oil via a co-processing method. This positions them as the first producer in Thailand, directly addressing global policies like CORSIA, which mandates greener fuels for airlines.
And does their reputation help there?
Definitely. PTTGC's strength isn't just the product, it's their governance pedigree. They've had a decade-long SET ESG AAA rating, ranked #1 globally in chemicals by DJSI for years. That builds long-term stakeholder confidence.
Okay, so PTTGC is betting on bio, circular, and SAF. Meanwhile, IVL's big transformation, IVL 2.0, isn't just about debt reduction, is it? It's also about making their operations fundamentally leaner.
Yes, absolutely. A primary focus for them is operational optimization through something called Project Olympus 2.0. They're aiming to unlock an eye-watering $450 million per year in cost efficiencies.
$450 million a year. That's huge.
It is. And if you connect this to the bigger picture, they're trying to fundamentally change how their rather decentralized M&A-built global platform actually operates. The goal is boosting operating rates substantially from around 74% up to 89%. That's a massive jump in utilization if they can achieve it.
And are they also refocusing their product portfolio, maybe chasing higher margin specialized areas like PTTGC is with LDP?
Correct. They're launching a new high-potential downstream group called Indovinya. This will focus on more specialized markets like home and personal care, crop solutions, things like that. Less commodity, more specialty.
And the financial targets tied to that?
Overall, IVL expects to generate about $350 million per year in added value just from sustainability innovations. And that's on top of the $1.3 billion in cash they plan to get from those asset sales we discussed earlier.
Okay, so after this deep dive into the spreads, the balance sheets, the valuations, the strategic pivots, let's bring it all together. Let's summarize for our listener based on the two investment profiles you asked us to analyze. Who wins for stability and who wins for rebound potential?
Okay, so for the listener who's primarily focused on cyclical rebound and growth, I think IVL presents a very strong, though riskier case. Because they have the most aggressive cost reduction targets, that $450 million a year from Olympus 2.0. They have the lowest current valuation metrics, that 4.2x EV/EBITDA for 2025 we talked about. And they have the highest projected ROE rebound at 9.0%. Their IVL 2.0 strategy, if successful, really offers maximum potential upside leverage once the supply cycle finally shifts.
Maximum leverage, maximum risk.
Okay, and for the investor who's maybe less focused on that aggressive rebound and more interested in the most stable dividend income they can find in this notoriously volatile sector.
For that profile, PTTGC is the clear choice for stability. They maintain that disciplined financial policy, high DSCR, investment grade rating, and it's backed by their highly integrated, diversified, and historically more stable operational platform.
And the dividend yield itself. They also have a slightly higher projected 2025 dividend yield, forecast at 5.3%, compared to IVL's projection of 5.0%. Plus, Those established ESG credentials we mentioned offer a necessary layer of non-financial stability that, frankly, large institutional funds increasingly prioritize.
Stability versus potential growth, a classic investment dilemma.
Indeed.
All right, that brings us to our final provocative thought for you, the listener. Despite all the current cyclical pain caused by that persistent global oversupply we've discussed throughout this deep dive, the long-term viability, the actual fate of the petrochemical industry increasingly depends on successfully navigating this irreversible global pivot towards low-carbon solutions.
Yeah, that's really the crux of it looking forward. So the key question for every investor watching this space isn't if the cycle will eventually turn, because it always does. The real question is, how quickly will the premium valuation for these green products, things like sustainable aviation fuel, specialized bioplastics, how quickly will that premium actually materialize and grow large enough to offset the persistent margin pressure we see in traditional commodities?
That answer, when it comes, will ultimately define which of these giants truly thrives in the next decade.
Precisely.
Thank you for joining us for this deep dive into the petrochemical space. Don't forget to like, share, and subscribe, and come back for more exciting analysis like this. Thank you.